Okay, shall we start? We have an elite group of tax-concerned individuals here. It's reassuring to know that tax is so under control that and it worries so few people. My name is Neil Warren. I'll be chairing the next couple of hours, and I won't go into great introductions because I've been told you've got all this information in the blurbs that you've got in front of you. But we will be having a range of different points of view from industry, professions, academics, economists. Gosh, John, 2 economists on a panel like this is pretty impressive. So John Freeburn from Melbourne Uni, Gordon McKenzie from New South Wales, Mark Frisier from Clayton Utes, and Julian Humphreys from KPMG. I don't want to say too much. We'll have all plenty of time to say things as we proceed. The order is going to be basically around a bit of a warming up, if you like, to the issues to get you kind of into the groove of the points here that are the topics. I've got a number of questions that I'll ask of the panel and might end up answering myself. We'll see how we go. And then from the floor, we really want as much discussion from the floor as well as across the panel. So I will go to our first speaker, and John.
Thanks, Neil. So I wanted to start off and just ask myself, where does taxation fit into the financial system? And as a simple economist, for me, the financial system is really trying to coordinate the decisions of people who save, which can include households, businesses and governments, and people who can invest, which again are households, businesses and governments. And essentially, the rate of return is the sort of bribe to get people to save, and the rate of return is a cost that investors have to pay to do it. And if we had a tax-free world, the rate of return required to earn by an investor would be exactly the same as the after-tax rate of return received by the saver. So what does income tax do? Well, what income tax does is put a wedge between those two returns. So the investor has to earn a higher pre-tax rate of return, and the saver ends up with a lower after-tax rate of return. And what that does is reduce a bit of saving and reduce a bit of investment. How much it reduces saving and investment depends on the elasticities of savings supply and investment demand. And of course the interesting story is Australia is a net capital importer. So ever since the first fleet arrived, we've borrowed 2 to 6% of GDP from non-residents. And so we face a fairly price unresponsive or elastic supply of foreign capital. So let me then briefly touch, what does income taxation do? Essentially, it is putting that wedge between supply and demand. But then when we look at the Australian taxation of savings returns, it's what we call a hybrid or mongrel mess. Different options face totally different tax burdens. So if I was to put my money into a financial deposit, a bank or a business debenture, or the dividend return I get on equity, I would be taxed on the nominal return. There'd be a tax on an inflation component and a tax on the fact that I delayed my consumption. even when we've got inflation of 2.5%, that's a much higher rate, effective rate, than the statutory tax rate. On the other hand, if I were to put my savings, invest in my own home, there'd be no tax on the earnings. No tax on imputed rent, no tax on capital gains. Surprise, surprise, Australians love McMansions. On the other hand, if I was to put it in a second property, it'd be somewhere halfway between a bank deposit and my own home. I pay tax on the rent income I get, less all the expenses. It's not just the negative gearing, it's local rates, it's repairs and maintenance, and so on. And then when I sell it down the track and realise a capital gain, I'd pay half the rate. So there's kind of an incentive to delay it. And surprise, surprise, in Australia, at least half the return from buying a second property is not the rental income, it's the capital gains. That's how we play the game. But then if I invested my shares in equity and the company kept the returns, didn't pay them out as dividends, and reinvested those funds in the company, would have paid a 30% corporate tax rate, allowing for a few concessions. And then down the track, when I cashed in those shares, I'd pay a capital gain at half the rate. Now that's actually a pretty good deal if you're a high income earner. But it's actually a shitty deal if you're a 15% taxpayer. And then we come to the lulu of superannuation. If I have an employer contribution, which is not a big part of the action, employee contribution, would come out of my after-tax income, and then the fund would pay 15% on the earnings. So that's generally better than putting it in a bank deposit, but it's not as good as putting it into my own home. But a much better deal is if I get the employer to put it in for me. The 9.5% super guarantee or salary sacrifice. Then only 15% comes out of the original labour income, and then 15% on the earnings down the track. Now, if I'm a low income earner, that's not a very good deal. But if I'm a high income earner, my God, that's a good deal. And there are the most deserving people. They really need the tax breaks. They're people who need to be encouraged to save for their future. So what have we got? This sort of a hybrid mess of very different effective tax rates on different savings options. Lo and behold, we have a distorted mess of investment and saving. We're throwing productivity away. We're creating a very nice industry for tax avoidance. It's not evasion, tax avoidance. So what should we do about it? Well, we could level everything down to the way we treat owner-occupied housing. No tax on earnings of anything that we save. And in a sort of theoretical ideal, that's a neutral tax treatment on whether I spend or whether I save. And the real hassle is no politician in this country seems to be game to say we're going to change the story for owner-occupied housing. And that's where the majority of us have our savings. But the equity effects of that are pretty disastrous. The higher income, generally the higher your share of income, is capital income. And then again, the assumption that you want to have a non-deciding tax on savings consumption decisions is in a kind of a second best world. You then have to push up tax rates on labour income. So the real world is you want to equate the marginal efficiency costs on distorting savings and investment decisions just as you distort labour decisions. So that might lead you to something like the Henry proposal, which was essentially that you have a 40% discount on all forms of household savings income. That would be kind of progressive. He also essentially proposed that taxation of super would get much closer to the way we tax owner-occupied homes. That is, it would come out of after-tax remuneration, and then he'd have a 7% flat rate on earnings. Or you could go the Nordic model, where they essentially have a dual income tax system. Labour's taxed at a progressive rate. For small business, you impute their unincorporated income as to capital, and the rest is labour, and then all capital income is taxed at a flat rate, and generally at a low flat rate. If you want to come to an absolute lulu, think about the taxation of non-residents, the people who provide up to half the funds for our large companies. If it's debt finance, it's a deduction for the business, and then they pay a withholding tax that's anything between 0 and 10%, depending on the bilateral tax treaty. Treasury numbers were the average rate was 3.5%. On the other hand, if you were to invest as a non-resident in equity in an Australian company, and the company paid franked dividends, then we would have collected 30% corporate tax on those earnings. No further withholding tax. Surprise, surprise, there's a whacking big incentive to debt finance rather than equity finance. For what reason? Because we want to screw the country up. On the other hand, if a company doesn't have franked dividends, they're unfranked, it goes out with a holding tax rate between 0 and 15%, again depending on the tax treaty. So again, here's an incentive for investors, non-resident investors in Australian companies. Let's get into companies that can get every tax break they can get and not pay any corporate tax. And then, of course, the retained earnings, then they come from after corporate tax, but there's no further capital gains tax in general. So we've got this very uneven, non-neutral story. Could we fix it up? Well, I think it'll be part of the BEPS debate on how we tax multinationals, but it's having a look at restructuring these dozens and dozens of bilateral tax treaties. But it's clearly causing distortions. So I would push for getting some uniformity on the tax treatment on different earnings. And ideally, I think, you'd have a lower corporate tax rate and you'd have withholding rates on unfranked dividends and debt interest that got very close to that corporate tax rate. That's what would give you neutrality. So they're just a few thoughts on the mess that is our income tax system, and that is inducing the financial markets to allocate our funds in ways that are far less than optimal. Thank you.
So look, the opportunity to make an opening statement at a panel discussion should always be used to make sure that the discussion that follows is lively. So let me see if I can do that. Murray says his report is a blueprint for the financial services industry, and that it may be, but it's certainly not a blueprint for tax reform of financial services or tax reform more generally. What it does do is raise a number of issues for consideration, and they've been included in the material that's been given to you, for consideration as part of the government's white paper process. And I guess to be fair to the inquiry, that was consistent with the terms of reference that was given to it. So they were just asked to make observations around taxation to feed into the government's white paper process. I do think, however, that there were particular taxation issues relevant to financial services, and we've touched on some of them with what's just been said, particularly around withholding tax, that we need to make sure don't get lost in the broader tax reform process, which is going to be focused on superannuation and the GST and those more macro issues. So I'm a little bit disappointed in terms of the report not being stronger on some of those recommendations or observations around tax that was particularly relevant to financial services. But before I jump into the specifics of the tax observations, I just want to sort of set the scene more broadly for the tax reform debate and things we're going to discuss today, because the discussions need to be had in the context of the broader economic and political settings that the tax reform process is going to play out in. And to set that scene, I've taken some slides from a much longer presentation around tax reform that I've done, and want to take some of these observations back to some of these observations around broader tax reform back into what Murray has said. So if I look at the history of tax reform, you'll see that there's generally been a 10 to 12 year cycle of tax reform in Australia, going right back for about the past 100 years. Now, if you look at that, you might say that we're a little bit early in this cycle to be embarking on another tax reform process, given that Henry delivered his report in 2009. But the observation I'd make there is that we're probably 1.5 recommendations that came out of the Henry report that have actually been enacted, and therefore we're probably actually late in the cycle rather than early coming at it again. As I mentioned before, the terms of reference for Murray were to provide observations into the white paper process. So what does that look like? Input has been sought on scope and issues. We're expecting a green paper, which is an issues document or a discussion document, to be issued the middle of this year. The white paper was originally timed to follow late 2015, so late this year, but now perhaps may be pushed out to 2016. And obviously the white paper being the government's policy, which it's likely to take to the next federal election. So that's the tax reform process. What are the challenges that the tax reform needs to deal with? There are many, but I've picked out a few to highlight. The first is a current topic, given the release of the intergenerational report last week, and that is the ageing population. And you'll see from this graph that from about now, as the baby boomers retire, there's a steady decline in the percentage of the working age, of the population that is of working age. And in addition to all the other challenges it brings around the cost side of the ledger, it also has a significant impact on the income tax base and the superannuation tax base, as we have these people moving from accumulation phase taxed at 15 into retirement taxed at nil. And so thinking about both the income and the expense side of the government ledger, you'll see from this diagram that over the next 10 years, government payments are expected to exceed receipts. Now, I'm not going to go into whether there's a budget emergency, but those are the projections. And given what is on my next slide, I do note that these projections are significantly improved through bracket creep. And on bracket creep, it's projected that next year, the average full-time employee will again hit the second highest marginal tax rate of 39%. So any solution on the revenue side needs to ensure that the social compact between individuals and government is maintained. If I just shift to the expenditure side for a minute, there are many challenges here. This graph is from the New South Wales budget, which shows the impact of the federal government's changes to health funding. If the previous National Health Reform Agreement was to continue, the Commonwealth funding would have grown as a percentage of total New South Wales health expenditure over time to 2050. Changes announced in the last federal budget to cap those increases will see a significant gap emerge, and in fact that the federal funding as a percentage of the whole declining. Now, the cynic in me would say that that was done with the purpose of getting the states to become the first movers on a GST discussion, but I'll hold that one for a little while until later on. Health is just one part of this equation. There is also the National Disability Insurance Scheme that requires funding. There are the Gonski education changes, which also require funding, and so there are significant challenges in this regard for government and revenue. So I just want to talk about imputation, and I want to make some observations about the company tax rate. The graph on the left, Australia's company tax rate as compared to the OECD average. There are two OECD lines there, an unweighted average and a weighted average. The weighted average is distorted by the US and Japan being about 50% of the OECD numbers and having, well, I was going to say relatively high tax rates, very high company tax rates in those two jurisdictions. The graph on the right shows the company tax take as a percentage of GDP, and what that shows is that Australia has a significantly higher reliance on company tax than our peers in the OECD. And there's a further slide which I haven't included in here, but what that shows is that Australia is overweight in its reliance on direct taxation and underweight in its reliance on indirect taxation when you compare to our peers in the OECD. So there are some issues with company tax. I've mentioned some of them already. The point about company tax impacting real wages, I think, is an interesting one. So when there's a discussion around imputation and what we should do with imputation, I think the extent to which there can be a trade-off between either removing or limiting the imputation system and what that could do to the company tax rate is important. Pure imputation means that company profits are taxed at the marginal rate of the shareholders. This means profits held by superannuation funds are taxed at 15 or 0, depending upon whether you're in accumulation or pension phase, whilst profits held by non-resident investors are taxed at 30, and that was mentioned before. Australia and New Zealand are the only two jurisdictions that run an imputation system. There have been other jurisdictions that have played with it, both in Europe and Asia, but they have implemented it in a limited form and it has subsequently been removed. And Australia is the only jurisdiction that has a refundable imputation regime. The GST, so there are some observations made around the GST in the report. Any tax reform discussion needs to include the GST, and it needs to be a rate and base discussion. In relation to rates, as I mentioned earlier, Australia is underweight in its reliance on indirect taxation as a source of government revenue. And I think it is correct to say that, it's incorrect to say that the federal parliament can't act unilaterally in relation to the GST. So we hear a lot about the GST being revenue that's collected on behalf of the states. That is the current legislative regime. There is nothing stopping the federal parliament changing that. When it comes to the GST base, there are plenty of interest groups wanting to colour the debate in the base area. In relation to food, the proposition that it hits low-income earners the most may not prove to be correct. There's a quote there from Saul Eastlake talking about who actually consumes GST-free food. And to give you a feel for how much revenue might be at stake associated with potential rate and base changes, there are some very basic numbers on those slides. Now, they are very simple calculations. They don't take into account second-order effects, nor do they take into account any sort of compensation package that you might need to run with them. But if you were to go to 12.5% and include food, there's $21 billion of revenue that might be there coming off a $50 billion base, so that's a pretty significant improvement. As I said before, interest groups will colour this debate. In relation to financial services, there would be a strong preference for expansion of the base into education, food and health, rather than an increase in the rate, and that would be because the GST rate for financial services is an above-the-line cost. I'd just make the observation that in pushing for a base debate, that the reduced input tax credit regime would get swept up into that, and that is a pretty significant concession to financial services when it comes to GST. My final point, some observations on negative gearing, which were mentioned earlier as well. In 1998-99, the net taxable income from landlords was 700 million of profit. 10 years later, and I know this is these are not recent numbers, but it shows the movement, the net tax loss was $6.5 billion. So negative gearing moving from actually positive rental income from landlords to a significant loss being used to shelter gains on other income. We are out of step with the rest of the world when it comes to our approach to negative gearing. As was mentioned, I get a relief for losses I make during the life of the carry of the investment against my other income at my top marginal rate, but any capital gain made at the end is taxed at the discounted rate. So look, those are a few comments to open the discussion. I'm going to pass over to Mark to provide his comments, although I don't think you're next. I think your slide was before mine.
Not Gordon Mackenzie. No, I'll pretend to be Gordon Mackenzie. So I blame Gordon for any misstatements, please. Look, I'm indebted to John and to Julian for a couple of well-considered opening sets of remarks. I think really they've hit the major points in terms of reform and indeed the process for reform. So I'm going to be like a bit of spack filler here and just fill in a few points around the principles that they've already discussed and just make a few observations that about those issues. I mean, the first observation I want to make, going back to Julian's slide about the process, is that I must say I have a very uneasy feeling in my stomach that all this wonderful discussion that we're going to have is for naught. The reason I say that is I think we can learn lessons from the past. In fact, I've got a quote here from the UK, Sir Arnold Robinson, Cabinet Secretary under the UK Prime Minister Jim Hacker, who remarked, "The less you intend to do about something, the more you need to keep talking about it." In fact, I'll pinch. No, I can't go back to Julian's slide, but you know, as he indicated, we've got an issues paper which hasn't issued yet. We're supposed to issue about tax reform back in November, I think. December was mooted last year. Apparently it's still sitting on the Treasurer's desk. He wanted to sort of leave it for a few weeks after the intergenerational report. Now, the issues paper is really just going to say, I think it's going to be a bit of a non-event. It'll say, Australia's a globalised economy, we've got issues with capital importing profile, we've got multinational tax avoidance, you know, the GST raises so much, and what do you think? It's going to be that sort of paper. After that, we've got a paper which will set out some options. And again, that's being delayed to, I don't know, maybe later this year or early next year, which I think is the green paper. And then we've got the white paper. And I think the good oil, as I think Julian mentioned, is that the white paper is going to come out just before the election. I mean, it all sounds very yes, Minister, green papers, white papers and so forth. Just looking back through history, Dr. Hewson, of course, who you know I admire for the work he did in Fight Back, particularly in version 1 of Fight Back, that was released in November 1991. That was 18 months before the unlosable election, which he happened to lose, you know, after the birthday cake scenario. And that was, you know, the progression there was he actually did amend Fight Back and released it, I think, 3 months or so before the election. But there was a long gestation period on a really significant document, and basically, really, he stuffed his chances of getting elected. In 1996, John Howard won that election with the second largest majority in history up to that point of 45 seats. He released the ANTS paper, a new tax system, in August 1998. That was 3 months before the election of that year. Obviously, he had a significant majority at the time he released that. That's the one that introduced or raised the prospect of GST, and he almost lost to Beazley in that election. It was a massive swing, and I think they had a dozen seats at the end of it. But that was a pretty close run thing at the end of the day. So against all of that, if they're going to release a white paper with 3 months to go before the election and they're running kind of 50-50 or 48-52 in the polls, are they going to do some of the really brave things that a lot of people are saying they should do? I mean, are we going to get a broad and based GST with a higher rate, which to me makes a lot of sense, with some compensations for lower income earners? Well, good luck. Are they, and as John raised the prospect of imputed income in respect to the family home, are they going to do that? Well, good luck. And that would be a real shame because that would mean that really before, sort of going back to before the Henry report, and that issued in, I think, 2009-10, there kind of hasn't really been there wouldn't have been any successful platform of reform. And in fact, right now, if you've got anything to do with the reform process or dealing with the Treasury or the Tax Office, they're going to make a couple of changes this year to employee shares. They've announced earn-outs. Basically everything else they're saying, put it in the white paper. So they're really deferring consideration of any tax law change because really that's part of the white paper process. So if that's a fizzer, basically nothing's going to happen for 2 years and arguably no fundamental reform, over the last decade or more, I suppose. So we can only hope. It's interesting too. I went back and looked at the new tax system paper, I took the overview document. There's an overview and a more detailed document. It's kind of interesting just to see what they were saying in the overview. Just got a couple of quotes here. This could have been written today. Choosing to do nothing or trying to patch up parts of the existing system would condemn Australians to a future of higher taxes, ever greater reliance on income taxes, more evasion and avoidance, greater unfairness, more complexity, and higher penalties for Australian exports. This is 1998. There's another one. There is simply no basis for a system of state indirect taxes on business that are highly distortionary, penalise certain sectors have only evolved because of the various restrictions on state indirect tax powers. There is simply no sense in persisting with a system designed when modern business structures and the globalised economy were not even in prospect. All of these things are exactly the same things that have been said today. Again, it makes you a little bit sanguine about the prospects, but we bash on. John spoke about the home. That's a big issue that's being talked about. It just strikes me as well, with a lot of the new business models, there's a sort of a compression, if you like, of this distinction we've always had in the tax world of private versus business. And in the tax world or income producing, there's sort of two distinct things. So, for example, your home, you don't recognise imputed income, you also don't claim deductions. We always knock out deductions for home to work travel and things like that. In terms of earned income or business income, there's always this quite bright line distinction that has been drawn in the past. But these days, you've got all these new business models which are quite interesting that are emerging. Airbnb, Uber, where people are venturing their private assets into business. Now, in a sense, it's really just a compliance task of identifying what are the private assets versus the business assets. But it just seems to me that the erstwhile distinction between private and the business world is actually merging in some way. And maybe an extension of that is looking at things like the family home. That's also interesting because it's pointed out in the Murray report. In 1997, I think the number was it took you 0.8 years of gross disposable income or mortgage interest. Sorry, the percentage, 8? That can't be right. mortgage interest, I might have had this wrong, but it was 0.8 years of gross disposable income in 1997, has gone up to 1.5 in 2008. I think what they're saying there is, I'm not quite sure what the measure was, the way I've written that down, but basically the leverage against the family home has kind of doubled in that 10-year period. It's probably gone up a lot more since. So there's a lot of deductions being generated against the family home, which of course if you impute income, you'd need to grant, I guess, offsets for those sorts of expenses. I think the capital gains tax discount needs to be looked at. I'm not sure that there's a really sensible rationale for that. I mean, it's interesting, you look at the tax expenditures for individuals, and that's a $5.8 billion line against the capital gain tax discount. So that's a really significant number. I mean, turning to another issue, withholding tax, which John talked about at length, so I won't go into that in any detail, but in the 2014-15 tax expenditure list, the tax expenditure on interest withholding tax, which I think relates to treaty exemptions and 128F, which is the publicly offered notes and syndicated loans, is $1.8 billion. So, you know, in a way that's small change in the context of the numbers that we're talking about compared to some of the other incentives in the system. And so I think I'll just finish for the time being to talk about super, because I think everybody's going to have a go at super today. It's a controversial issue. I find myself probably aligned a little bit here with Christine Milne, which I'm not often aligned with on issues, so I suspect I might have this wrong, but you know, it seems to me that we've got the wrong mindset for super. You know, we come at it from the point of view that we're all entitled to a tax break for our retirement, as distinct from kind of looking at super as a tax expenditure. So in other words, it seems to me that if you equated, this might, economically, I'm not sure whether this is valid or not, but you know, you look at a tax expenditure, in other words, something that you're getting a benefit out of an incentive in the tax system, and you equate that with a tax transfer. So in other words, something like a welfare payment. Well, a guy with, or lady with, you know, a $10 million super balance and earning $800,000 a year wouldn't expect to be getting a welfare payment from the government. I mean, in those terms, it's just ridiculous. Of course you wouldn't. But they just, I mean, I was saying to Neil, I played golf with a guy the other day, and he was, when he found out I was a tax person, he was complaining. He said he had $300,000 in imputation credits, and they're probably going to be stuffed up in his super fund, and they're going to be stuffed up under the new changes to the law. But they'll let the workers off. They won't change them. There's no votes. That's where the votes are. Well, he's not the only one with that sort of mindset. It's ridiculous. I think we need to look at have a mindset where we look at tax expenditures and in a sense equate those with payments. And the tax expenditures total for 2014-15 for super was $30 billion. So let's put that in perspective. Interest withholding tax 1.8, super 30 billion. It's really a huge issue. I'll stop there.
Thanks, Mark. Just late January, I was contacted by Christine Milne's policy advisor looking for some suggestions on the way that super should be taxed. I'll pass her name on to you, or your name on to him. And good luck. Now, when I told her my background, he very politely said, "I probably don't want to speak with you." Okay. Am I going up or down, or sideways? Up. Okay. Down. Okay, that's me. Okay. Thanks, Mark. That was great. What I'd like to do is have a look at some of the recommendations that came out of the panel's recommendations. First of all, I'm principally a tax guy, but it surprised me, as I do have an interest in financial services, it surprised me that the panel, which was commissioned to look at the efficiency of the system and regulatory of the system, actually gave us some comments on tax. Nevertheless, they did. So what I propose to do is have a look at some of those recommendations and just give you my observations on them. The first one was a suggestion that they get rid of the distortion on deposit income. That's both bank deposit income and fixed income securities. They didn't say specifically, but I guess that they were mirroring what the Henry Review said, which was that there should be a 40% reduction in the income recorded from fixed interest investments. My response to that would be, first of all, is there a difference between a bank deposit and, in fact, a saving? In other words, is a bank deposit a transaction account, or is it, in fact, a savings account? The second observation on that is that if you speak to stockbrokers, they will tell you don't use a bank account as a transaction account or as a cash account. Use a property fund or an infrastructure fund, or at least before the GFC it was a good thing to do. I'm not so sure it is now. The question then is that if you give fixed interest income a 40% discount on their tax bill, why don't you do the same for equivalents like property and infrastructure funds? The third observation I'd make about this recommendation by the panel is that ADIs don't have a spectacular track record of managing tax-preferred accounts very efficiently. And I've got two examples there. One is RSAs, and for those not familiar with an RSA, it was the retirement savings accounts. A couple of years ago, when the life companies had 90% of the superannuation market, the banks went up to Canberra and said, look, we can't get into that market, the life companies have got it. Would you allow us to treat a bank account and tax it like a superannuation fund? That is what an RSA is. Okay? The fact of the matter is that if you've got a 40-year investment like super, the last place you want to put it is in a bank account. Anyway, Treasury said, okay, well, for competition reasons, we'll let the banks tax an account like a super fund, and they're called RSAs. They're an abject failure. You wouldn't use them as a long-term savings vehicle. In any case, the banks resolved their competition issues simply by buying up all the life companies, I think, except for AMP, which still stands alone. The second one is the First Home Owned Savers account, which is designed to deal with a lot of the tension which is in the press this week and last week, and that is, you put money in your super fund or do you buy a house? The deal with these accounts was, again, that they were bank accounts effectively taxed as a superannuation fund. They got superannuation fund taxation. The technicalities around them made them very unattractive. You had to run them, Adrian might correct me, you had to run them for at least 4 years with at least $1,000 deposit in each year. Okay. Now, if you didn't use the balance to buy a house, your first home, it then went into your super fund. Okay. It's not hard to guess that the only people that used that account were the kids of wealthy parents that wanted to have a special savings vehicle for the young kids. Okay. But again, I make the point that both retirement savings accounts, which were bank accounts taxed as a superannuation fund so that banks could compete with the life companies, didn't work. And similarly, when they gave tax preferences for first home owners, that didn't work as well. Now, you probably may have surmised that I'm actually arguing against a tax concession. So when I was contemplating speaking today, I thought, Gordon, maybe you've been in academia too long, but I am pleased to see that I've been made a professor, which is great. So, okay. Adrian will get that joke. I'm a senior lecturer, I'm not a professor. In the hierarchy of academia, and David appreciates this, that is a very serious thing. Okay. But I've got the photographer to take a picture of it, and I think David suggested it go up on Twitter, which it will. Okay. Okay, so again, the panel, again, it was intriguing as principally a tax guy to see the panel, which was commissioned to look at efficiencies in the financial system, come up with these tax suggestions. The second one was respect to dividend imputation, and if I read it correctly, it was get rid of dividend imputation. Now, I take the observations that Julian made. If I understand him correctly, we pay a lot of corporate tax, which was, I think you were saying, higher than the adjusted OECDs and unweighted and weighted. In any case, the reason that the panel suggested to get rid of the imputation system was fourfold. First of all, they said there's going to be a reduction in the corporate tax rate, so the problem which dividend imputation cures, which is over-taxation, which is where you've got a corporate level tax, balance up the tax is then taxed again at shareholder level tax. If you reduce the corporate rate, it mitigates the problem. Okay? The second observation the panel made in terms of getting rid of the imputation system was that it favours Australian funding. Fair enough, it does. because I mean, the two professionals on our panel would know better than I do that it's only Australian corporates that pay Australian tax that can pay dividend imputation credits. The third observation the panel made was it makes foreign funding less competitive. In other words, the bias given to Australian funding, Australian shareholders, makes foreign funding less competitive. And the third observation, and I think it was either Mark or Julian made this anyway, and that, or I think it was maybe John actually, that super funds get refundable imputation credits. Okay, there were 4 reasons the panel argued for getting rid of the imputation system. Okay, a couple of observations. First of all, if you reduce the corporate tax rate, so what? You've still got over-taxation. You've still got taxation at the corporate level, and the net amount distributed to shareholders is taxed again. It's an over-taxation. Reducing the corporate tax rate just reduces the problem, but it doesn't make the problem go away. The second observation that the panel made was that imputation credits give a bias to Australian shareholders. Go and read the introduction to the bill. They said that's what they wanted to do. Okay. And I think John said initially that we are a capital importing country. We are, indeed. But if you read the second bill reading speeches for the introduction of imputation credits, one of the reasons they introduced it was they wanted to incentivise Australians to invest in Australian businesses, Australian companies. So, third one. And this one I really had to read a couple of times. And indeed, I read it on a Sunday morning when I was sober. That was a joke. Okay, but I thought, what are they saying what I think they're saying? The panel was saying that they ought to get rid of the imputation system for Australian shareholders because it makes Australian funding more attractive than foreign funding. But if you put it another way, you're saying you've got to increase the tax on Australian shareholders so that foreign funders can compete. I don't know. I'm pretty sure I got that right. I scratched my head when I read that. I thought, I'm like the Lex guy. I love foreign funders, but for me to pay more taxes as an Australian shareholder so that they can compete, because they actually set the rates, I figured, beyond me. The last point was, again, the panel said that with the imputation system, super funds, either in accumulation mode where they've got a nominal rate of 15%, as Julian said, or zero in pension mode, get either a 15% refundable imputation credit or 30% if they're in pension mode. And I say, so what? That just gives them the correct tax, doesn't it? I mean, the whole point of an imputation system is to get rid of the double taxation of corporate distributions. So corporate tax at 30% is then credited to the shareholder. So if you're a super fund, you've got a zero tax rate, what's the problem? Okay, you get it back.